So in today's video, what we're going to talk about is the reason why mortgage demand dropped to a 27-year low as interest rates pull back. So my name is Dan Frio. I do this report on a daily basis to keep you guys informed what in the heck's going on with real estate. I don't really focus on home prices because if you're out in Southern California, you're seeing house prices coming down, especially in Austin, Texas. But if you're in the central part of the country and parts of the East, you're actually seeing normal appreciation as usual. So let's really take a deep dive into mortgage demand and why rates are where they are today. So I can vouch for it. Anybody been looking for houses or in the mortgage industry or real estate industry for over 27 years? I have. I've been doing this coming up on 33 years. So that's why I'm a little bit gray down here. So let's really take a deep dive into a lot of this stuff. We saw mortgage rates, and mortgage rates are basically right at 7%. Some days they go up to 7.25. Some days they go about 6.9. Then they go to 7.2. They're bouncing all over the place. But yesterday we had a huge move in yields. And everybody kept asking me on YouTube and emails and things like that. They're like, Dan, what in the world's going on? Well, yesterday's video and yesterday's economic data was really nothing. So what really caused mortgage rates to basically spike yesterday? Well, let's look at some details. 2-year Treasury yields dip as investors assess interest rates outlook. So a lot of people are just sitting on the sidelines and they're saying, what is the Federal Reserve going to do at the next meeting? What's the Federal Reserve? What's the inflation numbers coming in at, and so forth. So that's what we're going to dig into. But let's get over to here right now. What we're seeing right now is the Federal Reserve, they came out, and this is one person that sits on the Federal Reserve Committee. Her name is Collins. Fed's Collins says policymakers can proceed cautiously on future rate hikes. Well, the one thing that's kind of really odd right now is very rarely did, when Federal Reserve people came out and spoke, very rarely did they have basically the same speech that they give it every time they come out and talk. This time, that's what they're doing. Usually they'll come out and they'll just say their opinion and what they think. But right now, they're all saying basically the same thing. And what is that same thing that they're saying? Well, if the improvements in inflation data is fleeting, further tightening could be warranted. If the data keeps coming in very good like it's been, well, they might be able to pivot and start reducing rates. You don't see that. You never are seeing, well, when we're kind of close to where we think things are at, so we're probably just going to sit on the sidelines and let this kind of play out. But if you really dive into the details of what they're saying, she's also saying near or even at peak for interest rates. So then you sit back and say, okay, she's saying, well, if data warrants it, they'll keep pushing up rates. But then she says right here, well, we're pretty much at the peak of where we expected it at the Federal Reserve level. And then you scroll down a little bit more, and they actually put it in here. And I didn't really realize this was in here until I just noticed it a little bit ago, so I highlighted it. It was prepared remarks. So instead of her coming out there answering questions and just giving her kind of just off the cuff comments, these are prepared remarks. Why? Well, the markets don't want the Federal Reserve basically, or any parts of this Federal Reserve, to come out and say, well, we're kind of like what the data's coming in at right now. Because when you see that information come out, those are the days where you see the stock market up 500, 600, 700 points, and you see mortgage rates plummet. That's what the Federal Reserve does not want to happen. So they're basically keeping everything tight-chested, and they're saying, well, if data warrants it, we're going to keep raising rates. We're going to keep raising rates. Pretty much on the sidelines, they're sitting there telling us that. But if you look at what the expectations are from the markets, if you go over to the CME report, so let's go dive over to the CME, the Chicago Mercantile Exchange. This is telling us what the Federal Reserve is probably most likely going to do at the next meeting. So you can see here, the CME Fed Watch tool. Stay up to date with the FOMC meeting notes. What is the likelihood that the Federal Reserve will change the Fed target rate at the upcoming meeting? Well, right now, the rate is 5.25 to 5.5. What's the probability that it's going to stay there? 93%. So 93% of basically Wall Street and investors are saying the Federal Reserve is not going to do anything because this is where we are right now. But let's focus in on what do they expect to do at the future meetings. So let's go down through here and look at the probabilities of what they're going to do at the next few meetings. So let me get my head out of the way. So here they are. The next meeting is coming up on 9/20 of 2023. There's a 93% chance that they're not going to do anything. You can see that right through here. They're not going to do anything. Now, at the next meeting in November, what's the probability of them increasing rates? Well, 40%. The probability of them keeping them right where they are, 57%. Okay, so most likely right now, all this data, what this is telling us is throughout the rest of this year and into next year, the Federal Reserve's most likely, data dependent, going to be sitting on the sidelines. And then from there, they're expected to pivot and pivot pretty darn hard. So let's get over to this one map. So if you're new to this channel, let's get over to, I'm going to explain to you one segment here. This is what's called the dot plot. Okay, so if you're new to the channel or you're new to economics, what happens at all the Fed meetings is that all the Fed members come in and they say, okay, here's where I expect rates to be at this year, next year, and future years going out. So if you look at this right here, the dot plot's telling us that this year we're basically right where the Federal Reserve wants us to be. Everybody's saying, well, there might be a 0.25% increase coming anytime soon. Well, you know, the probabilities that we just looked at in the last screen says, no, that's kind of off the charts. But then let's forward fast. We're not too far away from 2024. So what's the expectations in 2024? Maybe even 2025. Okay, so you go over to here and what's the expectations? Well, right now, like I said, the federal funds rate is about 5.5. If you look over here, what's the probability of where federal funds rates are going to be next year? You go over here, this is about 4.25. So that means between now and the end of 2024, the Fed's most likely, based on what they're telling us, are going to reduce rates by 1.25%. Now, that's not it. Let's continue out to 2005. What's the probability of where we're going to be? Well, you go over here and it's going to be about 3.25. So we're about 2% lower from where we are now to where they project us to be in 2025. Okay, so that's what we want to look at right now. But what caused basically the spike yesterday in rates? Well, right through here. So this is an analysis that we put out on a daily basis. The bonds were affected in a big part yesterday by a glut in corporate bonds. So let me explain how this all works for you guys. So what the mortgage-backed securities is, or let's go to the screen that I watch on a daily basis, and this is it right through here. Okay, so what I want to educate you guys on today is the bond market, yields, and so forth. So what creates a mortgage rate are bonds and bond yields. What bond actually controls mortgage rates? Well, it's right here. It's the mortgage-backed security bond. It's not the 10-year Treasury. So what you're seeing right now here on the mortgage bonds is they're basically completely flat. Okay, yesterday this market took a plummet because there was a glut of supply. So let me explain it. It's kind of like the housing market right now. You have no houses for sale, virtually any. That's why mortgage demand is at an all-time low, well, since I've been doing this. But the reason isn't, it's also compounded with mortgage rates. Well, it all feeds together. So let's look at it this way. You still have people, we have probably 20 or 30 consultations a day for people looking to buy properties. One, a lot of them can't find a house in their price range. And two, because of interest rates, a lot of people are struggling with those payments. But they're like, okay, I'd rather buy now and then down the road I can refinance because we know rates are going to go down and I'm avoiding the rush right now of all these people getting into the market trying to buy houses. Okay, but what I want to just explain to you guys is basically supply demand. Okay, and this is also the reason why house prices haven't crashed like a lot of analysts were expecting. Not me. Okay, so here's what you have. You have very limited supply of houses on the market. Okay, basically just it's if you have to sell, if somebody has to sell right now, they're putting their house on the market, or somebody's like, I really want to downsize, or new construction homes. Okay, so you have a limited house availability on the market because people like me who own a current house right now, which is called existing homes, we're not putting our houses on the market. I was at a wedding this weekend with a bunch of young people and who have bought their houses in the last 3 or 4 years. And they're like, I'm actually looking right now to rent my house and buy another house because I bought my home at such a good time and I have such a good rate, my property can cash flow. So now I can get into another property that I can kind of upgrade. I can get into it as long as I can afford today's payments. And I know down the road I can refinance to drive down those payments. Okay, why are they doing this? Well, they're trying to avoid the FOMO because what happens is once rates drop, and we're going to see those in the next 12 to 16 months, they're going to drop. You're going to have a glut of people coming back into the market looking to buy. What's going to happen then? It's going to push up demand or push up the prices because because now you're going to have still less demand or less product and more people into the market. Okay, so let's getting back to it. The reason why house prices haven't crashed, well, there's not a glut of supply in the market. You only have prices come down when you have excess to supply. So what happened in 2008 was this. You had subprime mortgages that a ton of people had, a huge majority, millions of people had, that were in a program which was this. Here's what the average subprime mortgage looked like. It was started out with a teaser rate. So let's say the rate at that time was 6 or 7%, but that person got maybe 5 or 4%, okay? And it was interest only. So that means their house payment was gonna be about half of what it normally should be. Okay, half of that. Because again, think about it. You're only paying interest on that loan and you have a teaser rate. Now, what happens over 2, 3, 4 years is those interest only features came out. So now that increased the person's payment each month by, let's say, $300, $400, $500, okay? Because now you have to start paying principal as well. But what started happening as well is those mortgage rates started to reset to normal rates. Okay, so you went from, maybe a 4% teaser to 5%, then the following year 6%, then the next year 7%, then it stagnated. Okay, that's what happened. What happened ultimately were home prices or home payments, I'd say, in some cases tripled. Many cases, or most cases, they doubled. So then people were sitting on the sidelines. They're like, okay, I bought this house. It was a payment that I could afford 2, 3 years ago when I had this teaser rate, interest only, and all this other stuff. Now I can't afford those payments. So what can I do? Well, you couldn't refinance because house prices were stagnant. So you're left I got to either pay these payments, which I can't afford, or I got to sell the property. Well, let's try to sell the property. Well, millions and millions and millions of people tried to sell their properties. So now you have a glut of homes in the market. And then what happens if you have a glut of supply in the market with just stagnant demand? Prices drop and drop and drop and drop. That's what happened. So in today's market, we don't have existing home sales. We don't have people in those positions where they're forced to sell their houses. So you don't have any supply. And that's in every analysis you look at. So you have no supply and you still have decent demand. So that's going to basically stagnate prices unless you're in an area that just went bonkers. I hate that word because I won't get into it, but you go into these areas that, saw 200% appreciation, like we reviewed yesterday in yesterday's video on Austin, Texas. They're seeing a 10% correction. Okay, if you're up 200% and you come down 10%, okay, I'm still high-fiving somebody because I'm still in a good position. So where are we going forward from here? Well, let's just go back to the CME. When rates do go down 1% from where we are today, and maybe in 2 years down 2% where we are today, you're going to have people entering back into the market and you're going to have existing homes coming back to the market. So we're expecting rates to come back down, house prices to stagnate and start to increase in the next 12 to 24 months. And that's basically the scenario behind this whole thing. So let's get over with all the news that we have today. Well, let's get over to our economic calendar. And here's what we're having today. Basically, yesterday and Monday, there was nothing. So that's why everybody was emailing me saying, Dan, what's going on with mortgage rates? They took a spike up. And I'm like, I don't know. Well, then we did our research and we saw that there was a glut of corporate bonds in the scenario. So today we basically don't have really much of anything coming out. And then on Thursday, we just have one piece of the puzzle that we're interested in. That's initial jobless claims. Why? Well, it's because the Federal Reserve, they focus in on two things. They have two mandates. One was price stability, AKA inflation, and two is full employment. But in today's market, they really want to see the jobs market taking a hit, because if the job market takes a hit, that means less people are working, less people are making money, so you can't spend as much money. Thus, it's going to drive down prices because there won't be demand for those supplies out there. And again, if you have dismal demand with oversupply, it's going to cause prices to come down. All right, so that's our agenda for today. So based on this information, what's going on in the bond market? It's all over the map. It's basically zero, it's down 20 and then zero, then up 5 and 0. zero. In the morning, it's really volatile. But based on economic news that we have today, I don't really think anything's going to happen. Okay, so let's get over to where mortgage rates are. Here's where they are, and here's where they ended yesterday. You saw we had a big spike in rates, about an eighth up in just one day. I'm expecting this to cool off because, again, there was really no data there. But these are the top 6 products people use when they're buying or refinancing a house. The scenario behind this is, well, Mortgage News Daily surveys lenders all over the country and asks them this question. If you had a first-time home buyer looking to buy a primary home, and it was a single-family home, those 3 things, and then that person had a 740 credit score and they were putting down 20%. So you might say, Dan, do I need to put down 20%? No. In most cases, you need 3% down. And if you'd like to talk about this, I'm going to give you my information at the end of this video. But these are the top 6 products that people use. But like I said, that's the scenario behind this. So if that's your scenario, most likely your rate right now is 7.2 to 7.25%. But it depends on when you locked in. So if you're in the process right now of working with a mortgage company trying to get pre-qualified, or you locked in and the rate just seems like it's way too high, I have an idea for you. I'm going to give you that information also at the end of this video. So what I want to go over right now is credit scores. A lot of you guys are calling on a daily basis going over, here's my credit score, I think here's my credit score, and so forth. But when we pull your credit, it's much different. It's a lot different in some cases than what we're getting. So what I'd love you to do is visit the website I created about 10 years ago. It's called creditscoresandmore.com. It educates you on credit and credit systems. You can see videos and a whole bunch of other things but there's links down through here where you can get your free credit scores, okay? In this system, when you click it, sign up for it. It's free. Don't sign up for any of the bells and whistles or subscribe to any services it has. The free version is plenty enough. But if you really want your credit scores that we as lenders are going to get, and you don't want a hard credit pool on there, just click here. This is going to give you your FICO score, and it's going to say your mortgage FICO score is X. That's basically the exact same credit score that we're going to pull. So if you're out there and you're like, Dan, I need some help with this. I'm looking to maybe buy my first house, but I got some questions. I'm looking to maybe house hack or maybe buy an investment property. How do I do this? Well, my name is Dan Frio. I've been doing this for over 30 years. I'm a mortgage advisor licensed in all 50 states as well as Puerto Rico, and I'd love to help you. The best way to reach out to us is basically there's probably 3 ways to do this. One, you can hit the apply now button up there. What it's going to do is going to ask you a few questions and then route you to us, but it's going to give us some feedback or data on you. So when we have that conversation with you, when you apply, we're going to know basically your scenario. Or you might say, Dan, can I call in and just ask some questions and do basically a live with somebody? Or, how can I reach you guys direct? Pretty simple. You can give us a call at 844-775-5626. That's 844-775-LOAN. Or you can email me right here at dan@therateupdate.com. Thanks so much for watching, guys. I'm going to ask you to do me a huge favor today. If you found value in this channel, please do me 2 things, and they're a little bit different 2 things. One, give this video a thumbs up and comment down below. Let me know what you think of this video and what you'd like to see in future videos coming up. So that is it for today, guys. Thanks for watching. God bless. Have a fantastic day, and I'll see you tomorrow. Bye-bye.